So capital gains, they are a very big deal. What's going on, everyone? It's Zach from On Cash Flow, and today we are talking about those capital gains because I want to teach you everything that you need to know about them. Because if you're in the business of growing your net worth, if you're in the business of getting on the path to financial independence, then you need to know about capital gains because it's a very important concept when it comes to investing, when it comes to growing your net worth, and when it comes to becoming financially independent. Let's first talk about the basic definition of a capital gain. So a capital gain is the difference in price that you sell something for versus what you bought it for. So let's say, for easy math, you buy a stock, like an individual stock, for $100 for one share. And then X amount of years later, you sell that share for $120. Well, the difference between the $100 and the $120 is $20. That $20 is known as a capital gain. And on the flip side, do people say that anymore? I don't know. But on the other way, if you would have lost $20, let's say that you bought it for $100 and you sold it for $80, well, there's a $20 difference there as well. But the $20 difference was a loss, known as a capital loss. So there are capital losses and there are capital gains. And that is simply just the difference between what you bought something for and what you sold it for, no matter which way it goes. We have what is known as two main different categories of capital gains or capital losses. And they are going to be known as long-term capital gains or short-term capital gains. Now, the difference here is key, because in most cases, long-term capital gains are going to be what you are after and what every investor should be after. But you also need to know what a short-term capital gain is. And the difference between the two is just 1 year. So anything that is less than 1 year, that is a short-term capital gain. So going back to my example, if you bought something for $100 and you sold it for 11 months later for $120, that $20 is going to be a short-term capital gain because you didn't hold that stock for at least 1 year. Now, going back to that, if you bought it for $100 and then exactly 1 year later, or even 13 months later, you sold it for the $120, then that $20 is a long-term capital gain. And long-term capital gains are much more generous to us investors than short-term capital gains are. And that's because short-term capital gains, they are taxed at your individual income tax rate. So that $20 is going to be added as income. So let's say you made $100,000 that year. Well, you'd have $100,020 because of that short-term capital gain of $20. In that case, it's going to be added to the end of your income, and it's going to technically be taxed at the highest amount. So whatever your marginal tax rate is, that is basically what that amount of money is going to be taxed at. So if you're in the 22% tax bracket, let's say, then of that $20, 22% of it is going to be subject to federal tax. On the other hand, if you instead had a long-term capital gain for that $20, that $20 is going to be treated separately than from your regular ordinary income. That long-term capital gain has its own tax rate, known as the long-term capital gains tax rate. And that can be anywhere from 0% to 28%. And it works a little bit more differently than ordinary income taxes. So really quick, before we move on, if you are enjoying this video, definitely give me a like, give me a thumbs up. It motivates me to keep making these videos, and it shows me that you like this information. At the same time, if you are interested in learning more information like this about personal finance, about investing, about growing your net worth, then I invite you to subscribe to the channel, because every single week I am putting out new information on personal finance, on how to grow your net worth, how to invest better, how to save money, all of that when it comes to personal finance. And I know that there is something that I can help you with. So please subscribe to the channel and like this video. But getting back to long-term capital gains tax, because that is really important. Like I said, you can be taxed anywhere from 0% to 28%. Now, the 28%, what is going to be subject to that? All right, let's work our way down. So 28% is the highest. A long-term capital gain can be taxed at 28% if it is from a collectible. So let's say that my plant here is a collectible item. I paid $1 for it 20 years ago. But someone was like, I really like that plant. I'll pay you $1,000 for it. And I sold that plant for $1,000, well, I have that $999 capital gain that technically I would have to report, and I would pay 28% on that capital gain because it was a collectible. So that's very unfavorable, right? But there is more. Generally speaking, qualified small business stock A long-term capital gain on that as well is 28%. There are some exceptions to the rule, but that is very in detail, and it's going to be beyond the scope of this video. And going back down just a little bit further, there is a 25% tax on long-term capital gains, and that is known as an unrecaptured Section 1250 gain. And that has to do with real estate. So let me put up a chart for you really quick. And as you can see, the unrecaptured Section 1250 gain, which is taxed at 25%, this is the depreciation portion of the capital gain on real estate property. So basically, as you own real estate property, you can depreciate it over X amount of years depending on what kind of property it is. And then once you actually go to pay capital gains on this, the unrecaptured Section 1250 gain can be taxed at 25% potentially. But again, I think that is also a topic that deserves a lot more discussion by more of a real estate professional. So that is also beyond the scope of this video, but just be aware that you can potentially be taxed 25% on a Section 1250 gain. Now, when it comes to like stocks and mutual funds and bond funds and things like that, when you're buying and selling them and you're making a long-term capital gain on them, those long-term capital gains are going to be taxed at different rates depending on your income tax bracket. And to really fully explain this, I need to put up another chart for you. So as you can see, the tax brackets, if you are in the 37% tax bracket, the top tax bracket, your capital gains tax is 20%. So technically, it is a lot more favorable than ordinary income, right? You would rather be taxed at 20% for a long-term capital gain than 37%. And if you are in the other tax brackets of 35, 32, 24, or 22, then your capital gains are taxed at 15%, which is again more desirable than the ordinary tax rate. And this is where the real fun begins. If you can manage to stay in the 10% or 12% ordinary income tax bracket, then your capital gains tax is 0%. If you can stay within that 10% or 12% tax bracket, then your capital gains are taxed at 0%. So that is a really big opportunity, and it's something that a lot of us in the financial independence community take advantage of. To really make sure that you understand how the income tax brackets correlate to the capital gains tax rates, you do need to know how income tax brackets work. And I've actually already made a pretty good video on that, so hopefully I remember to put it up in a card above me, also in a link in the description below as well. So if you don't understand how the marginal income tax brackets work in the United States, then you might not understand how these capital gains taxes work and how they're correlated to your regular income tax brackets. So moving on to capital losses, they're very similar to capital gains, but kind of the opposite effect. So you can have short-term and you can have long-term capital losses. Now, they can be used to offset capital gains in both circumstances. So short-term capital losses can offset short-term capital gains, and long-term capital losses can be used to offset long-term capital gains so that you are not taxed on them. So basically they work as a deduction. And unfortunately that deduction is limited to a set amount per year. Currently in 2020 it is limited to $3,000 per year. You can still have more than $3,000 worth of capital losses, but they are going to be carried forward into preceding years. So for example, let's say right now in 2020, for some reason you made some capital losses of $9,000. You sold some investments and you realized $9,000 worth of losses. Well, in that case, in 2020, you would be able to take $3,000 worth of a deduction against your other income as capital losses, but then that other $6,000 is going to be carried forward. So in 2021, you're going to be able to deduct another $3,000, and then in 2022, you can deduct the last $3,000. So essentially, capital losses can be deducted in perpetuity, which means they can go on forever, but currently it can only be up to $3,000 per year. So I hope that makes sense, but basically it's $3,000 per year until the total amount of capital losses that you claim reaches zero. That is the bulk of the capital gains and loss, except that there are definitely some more stuff that you need to know. For example, your primary residence or your home where you live, when it comes to capital gains, that is taxed a lot differently. They are usually excluded from these rules. And in many cases, you can make gains on your home and not pay any taxes on it, which is definitely a topic for another video completely. While at the same time, real estate investors, they can avoid capital gains tax by doing what's called a 1031 exchange. basically where they have a certain amount of time to buy another real estate property using the gains that they made from selling a previous one. Let's say we have a flipper here, right? A real estate flipper. They bought a house for $100,000, they fixed it up, and they sold it for $200,000. So technically they would have a capital gain there. But if they go and they take that money and they just go buy another house, or maybe they buy 2 houses this time and they do the same thing, they can basically keep doing that. And they can do like a 1031 exchange, and they can kind of defer those taxes for however long. Now, I'm not the expert on that. That is definitely content for a real estate investing professional. But just be aware that some real estate investors can defer their capital gains tax by using the 1031 exchange. Capital gains are one of the greatest things that exists today when it comes to our tax system and when it comes to manipulating our income to be optimal. And if you're on the path to building your wealth, if you're on the path to financial independence, then utilizing long-term capital gains should definitely be a part of your strategy. But there are many other things that need to be a part of your strategy. And if you haven't watched this video already, you need to watch it. It's going to click up right next to me. It's about how to achieve financial independence in 10 years or less. And I basically outline all the steps that you need to grow your wealth exponentially, like very quickly. And I know that you can get a lot of value out of that video. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.